So for today's agenda, we'll start with an introduction and then followed by a recap of the previous webinars. So don't worry if you missed out on any of the webinars. And then we'll start the discussion officially on offers and negotiation. And as I mentioned, we'll end with a Q&A session. I'd like to start by introducing our expert panelist, Eliud Njoroge. He's a corporate finance investment manager professional with prior experience as a finance audit and risk management manager at PwC. At BDO, Eliud leads the Manufacturing Africa program as a Kenya transaction facilitation advisor. His responsibilities include originating and managing deals, executing capital raising mandates, and assisting in transaction and advisory services. Eliud has extensive experience in financial modeling, valuations, capital structuring, and stakeholder liaison within the mergers and acquisition fields. He has conducted numerous valuations and investment return analysis, developed financial models, performed financial due diligence exercises, and contributed to debt restructuring and mezzanine financing for various clients across sectors. His specific experience is financial modeling, financial analysis, investment analysis, mergers and acquisitions, business valuation, corporate and finance, and project finance. Thank you for joining us here today, Eliud. And I'd like to just give a quick introduction for BDO Global for those who are just joining us for the first time. BDO's seamless global approach allows us to serve clients through a central point of contact, granting access to relevant experience across borders to be where and when our clients need us. BDO's strength is derived from our structure as a cohesive global network and dedication to internal integration. In each country, BDO member firms are composed of people who are knowledgeable about national law and business customs and familiar with local and international business. As our clients expand globally, our access to our international network can help them do business with a depth of experience in international matters, significant resources, and international client services and capabilities. I'd like to talk more about specifically BDO in East Africa. So we have several different offices across East Africa, including Kenya, Tanzania, Ethiopia, Rwanda. And we have a wider reach in Mauritius, Seychelles, and Madagascar. And as you can see, our mission is to provide high quality, efficient knowledge and innovation-driven professional services to our clients. Our vision is to become the most trusted advisors in our markets and to be recognized for our multifaceted leadership in the global BDO network. And this is just a quick run through for all the services that we provide. Our services vary from audit and assurance, business services and outsourcing, taxation services, advisory services, and much more. And this is just a quick breakdown of how BDO is a global market leader in corporate finance. BDO Global has completed 1,744 deals. It was voted the first financial advisor globally, first most active advisor and accountant globally in 2022, and second leading financial due diligence provider globally. And here are all the statistics about the corporate finance departments at BDO Global. And now I'd like to pass it over to Eliud. And once again, thank you all for joining us.
Yeah, thanks for that. A few minutes to put my video. Thanks, Meha, for that introduction. And also pleasure meeting all the participants online. I'll start with a recap. There have been two previous sessions on just the investment process, and I'll do a quick recap of the first two sessions before we dive deep into our topic for the day, which is offers and negotiations, which is more or less the last part in this webinar series. My colleagues, Sajan, presented the first two, and it is a pleasure that I'll be presenting this last leg of these webinars. So the first slide, we just went into the different financing needs across the business, and we came up that in improving deal structures, insurances, we need different types of financing across the business cycle. whether it's greenfield to operational issues to scale up to growth with a partner company and to establishment at scale. So at each individual business life cycle, we do need particular financing or a combination of financing, different level, various types of financing, and therefore, even as we see this financing, whether you are a startup, it can come from various sources, be it families and friends, be it venture capitalists and private equities, be it our banks, be it impact funds, and also strategic shareholders. In other parts of the market, we know there's also you can finance your business through an IPO and the capital markets. And we are seeing our capital markets really improving in that aspect. And therefore, these are the first series we just went through the role played by each investor, investment products in its success. Then we also looked at the different stages of the business life cycle, where we noted that at startup phase, we normally get angel investors along with venture capitalists, otherwise known as VC, provide the initial fuel for the product development. And then after that, it's all about equity financing and convertible notes to keep the momentum going. Then at proven product stage, we are looking again, venture capitalists still sticking around and private equity firms now looking for growth opportunities. And most of the tools you find that they are always equity financing and maybe some mezz financing become the go-to tools for scaling up and expanding operations. Fast forward to the high growth phase where things really, are picking up speed. And you find here that the private equity firms and the strategic investors, often big corporations, step in where they make private placements, which is the secret ingredients for entering new markets and fueling research and development. Then in the strategic investment stage, collaboration and diversification takes the spotlight. And here it's where strategic investors and private equity firms play a vital role by engaging in joint ventures to support the strategic initiatives and the tech innovations therein. And finally, we reach a point where the company has, already hit the big leagues and go public. Here we have institutional investors and private equity firms gearing up for the IPO journey, and they navigate legal complexities and preparing for global expansion. Therefore, the key takeaway remains that aligning with each stage of the company's journey paves the way for steady growth and success in the business world. Again, in the second webinar, we journeyed in the key considerations in investor engagement, and we explored, various ways of how investors are engaged. Again, it's important to engage effectively with potential investors with the aim of building relationships and trust, and to communicate the opportunities value. So here we have, again, preparing documents like the financial model, which show the quantitative element of the business. And we also have the information memorandum, which shows the qualitative aspect of the business. Therefore, these two documents should show the flow and consistency of the messages, and also anticipating potential concerns that will be raised. Also, you need to tailor the messaging to the needs and preferences of the individual investor being approached. And this comes along when you understand the investor's background and preferences through research and questions. They can help achieve this. Again, having a clear and concise pitch that highlights the unique value of the opportunity and providing evidence for potential growth and profitability without, going around in tangents or in circles. And lastly, just actively listening to feedback and questions, as this feedback can be invaluable in what we'll discuss today, the offers and negotiation stage. Then here, it is worth not taking feedback personally, but endeavoring to keep a good relationship therein. And lastly, timely follow-up and regular updates after meetings, calls, or questions shows professionalism and effectiveness of the company and management. So with those, that is what we discussed broadly in the last two webinars. So allow me to dive today in the offers and negotiations. But even before we dive deep in the topic of the day, I just wanted to recap of what the investment process looks like and the route and steps, taken to getting finance from an external source. So, as you can see, we've already done webinars on the first two. Today, we are going to tackle the last two with different, we'll see the different things that need to be considered when offers and negotiations are taking place. Oftenly, you'll find that an M&A process will always involve another company, either called a strategic investor or a financial investor, which is investing and taking full part or ownership of the business. And they always focus on the synergies and long-term added value that the two companies can attain. So that is always something you'd want it to bring it out. Already we've started bringing out in the second step of investor engagement. So even when it comes to the offers and negotiations, you need to show what is the value add, what synergy are you bringing in as the potential target company. Again, the key steps or the key process steps will be different, but these are more of the overarching steps and offers and negotiations, which leads to execution and close. They remain the same, though the nature of documentation, timelines, and requirements will differ from deal to deal. So for negotiation considerations, we need to consider, some areas that we need to be very important in terms of our thought process. And when you get to a negotiation phase of a deal, it means that the deal is almost getting closed. It's reasonably advanced, but there are still quite many key details to agree for the deal to close. It is therefore worth considering a few points, in this case, 6, when going into a negotiation. First of all is preparation. And what happens in the preparation phase is you are researching about the investor to understand the objectives and limits and looking how to align to these needs. And you'll find different investors have different objectives. They have different limits. They have different instruments that they use. And therefore, by preparing yourself, by doing research, will help you or will give you an added advantage or that edge when it comes to the negotiation, because you know what this investor wants in terms of whether it's the instrument that he will use or even whether he wants a significant minority or a controlling majority. So preparing is always the first thing you do when you are coming before you even go to negotiations. It says that when preparation meets opportunity, then the outcome most likely will be success. So in this case, preparation is key. The second one is aligning internal stakeholders. And here it's just where you ensure that your internal stakeholders and management are aligned at each step so that decisions and progress can be made collectively. Again, we've seen in some negotiations where internal shareholders, are not aligned, and therefore you find this really drags on the process. We even have what is called deal fatigue starts kicking in, and once deal fatigue starts kicking in, you'll find that the potential investor is getting less interested and can even pull away the potential deal on the table. So aligning as internal stakeholders, especially shareholders and management, is very key to ensure that progress is made. The third one is effective communication. Again, you need clear, consistent, and concise in communicating with the investor and ensuring that feedback is taken on board. and an open relationship is developed. Again, communication is key, and always having one point of communication. You don't want maybe today it's the CEO, tomorrow it's the CFO, the other day it's the chairman of the board, the other day it's the majority shareholder. No, you should have one point of communication, and it should be consistent all along. Therefore, this is key in ensuring that your negotiations are going on well. Remember, this is a process, it's not an event, but rather a process. And therefore, it can span from anything from a month. We've even seen some negotiations drag for a year. And the longer it takes, the more deal fatigue, the more likely deal fatigue will start kicking in. Secondly, it's confirming understandings in writing. Again, just putting key areas of agreement and next steps into writing, either via email after discussion, consulting on legal and financial implication of these areas where needed. It's very key, because sometimes you'll find that when negotiations go on in the room, most of them are verbal, and therefore there are always key takeaways, there are always key areas of agreement and next steps that are needed. Therefore, confirming these understandings in writing is key. Fifth one is building a rapport. Again, try to find commonality and connection with the investor to build trust. And this comes through preparation and just effective communication. This builds rapport. Now, the last two are actually more of the soft skills that are needed in a negotiation. In negotiation considerations. Actually, there are three, including communication. So you need this key soft skill of building rapport with your potential investor. Again, the sixth one is managing emotions. This is where you are trying to maintain a positive and collaborative relationship to reach a mutual position. Sometimes, as much as the negotiations, you want them to be a win-win situation, sometimes the potential investor can really push you to the wall, and the different stakeholders have to manage emotions, because we've seen deals scatter or not go through because one particular shareholder didn't manage his emotions. And just maintaining that positivity and collaborative relationship really helps in reaching a mutual position and a win-win situation. Again, when it comes to a deal's context, what is actually needed, the key areas to consider when it comes to an investment process negotiation. First of all, you need technical skills and strategic skills. And as for the technical skills, this determines the level and structure of the instrument used. In most cases, it's either equity or debt. It may be worth being open to different funding structures, valuations, and different levels of equity interest rates to get equity or interest rates to get a deal over the line. And these technical skills are quite key, because it will help you in understanding what the investor really wants you, to do. Sometimes other investors just want a significant minority, which is anything between 40 to 49%. Other investors want a controlling majority, which is anything above 70%. And with this, they'll come in with different structures of equity, and others may throw in even convertible debt options. And therefore, being technically sound on what is expected is key. And different rates of equity and different debt level of debts come in with different interest rates. You should be in a position to know whether, if it's a dollar loan, what is the reasonable rate. If it's a local currency loan, what is the a reasonable rate. So it is very important in just having this technical skill. The other one is the phasing and timing of investment. In most investments that I've seen in my experience, you actually receive the money in phases. And these phases are normally driven by key milestones that are set during this process. Therefore, understanding the phasing and timing of investment is very key, because it will assist you in knowing how to even position your potential target company to the investor. Lastly, on the technical part, you need to agree on the transaction parameters. In this case, what corporate entities and assets are included and excluded in the deal. And this normally happens where we see a group of companies participating, or rather a group of company participating in an M&A deal. You should be very clear on what which subsidiaries are actually going as part of the deal. We've seen some deals not come through because the transaction perimeter or the transaction parameters were not agreed or were not set initially, where the investor thought that he was getting a particular subsidiary, which may be the cash cow of the group as a whole, only for the potential target to say, no, this group is excluded. Therefore, setting and agreeing on the transaction perimeter is very important. On the strategic side of things, there is the post-investment working relationship between the company and investor, including reporting requirements. Especially for private equity firms, for certain DFIs, you'll find that they have certain reporting requirements, either monthly, quarterly, or even annually. Therefore, just understanding the post-investment working relationship is key, because this might call on for either additional resources or even a significant change in the way the company runs its operations. Secondly, from a strategic point of view, you need to understand the influence of investors and their voting rights versus the freedom of management. Especially, we see this in equity investments or even in some significant debts, where you find that the influence of investors and their voting rights on the operational decisions and sometimes even strategic decisions of the company versus even the freedom of management. Again, we even see when investors come in, they bring their own team to strategic positions such as CFO, where they want to, they'll feel comfortable that it's actually a CFO they've recruited that will actually, look out for their rights. So therefore, it is important to ensure that this has been discussed. And thirdly, just agreeing on the strategic vision and direction of the business and role of the investor in achieving mutual goals. Again, we've seen some deals post-investment. The potential target was thinking they were, from a revenue perspective, they were growing their product portfolio, but the investor who came in thinks that it's better to go to, bring the existing product portfolio to go to a new market. And therefore, you find that from a strategic vision perspective, they are not agreeing. And this comes in with its challenges, and it normally pulls down the company rather than pulling it up. Therefore, agreeing on the strategic vision of what's next after investment. Do we go to new markets with our existing product portfolio? Do we move on and have new revenue streams? Therefore, that is important. What I've used is an examples, but there are different ways of just knowing the strategic vision. Another one example I've seen in my experience, some investors come in with the mind of cost cutting, yet the target company has a mind of let's increase our costs to increase our revenue base. So all this, there are always conflicts that arise, and therefore we should be very careful when it comes to just agreeing on the strategic vision. Again, when negotiating, quickly there'll be some skills or some considerations. There is an agreement, you need some skills, the one that we've discussed, both technical and strategic. Your communication should be consistent. At the end of the day, when all is said and done, there needs to be a binding legal document in terms of a contract and an offer, and also what is the goal from this particular exercise. Then, when it comes to evaluating offers, we need to make informed decisions and fully understand the differences of the bids. Again, using my past experience, some potential target companies are quite fortunate to receive multiple offers, and it's not always straightforward to compare these given the different structures and conditions, even if the headline price offered seems clear. The devil is always in the detail. So, some of the important areas to consider when evaluating offers, the first one is the value or the price offered. And this is the total amount of investment offered for either debt or equity. However, this should not be the only factor to be considered. Other terms and conditions can significantly impact the overall value of the offer, which we'll see later. The second one is on the payment terms and structure. Again, the terms of how money will be paid in the number of tranches, what conditions need to be fulfilled, as well as the different instruments and the modes of financing. So the payment terms is always key, and how it will be structured. Mostly from my experience, you find that the investment is always released based on what we call CPs, conditions precedent. And these are key milestones that need to be achieved by the company for these funds to be released. And you'll find in some cases that there's always a push and pull when these targets are not met. But then the investor goes back and says, but you signed on the contract and these are the payment terms. And therefore you should be the target company should be in a very good position to understand the payment terms and structures and the conditions therein for these funds to be released. Again, we also need to think of contingencies. Again, these are payments and terms that come into effect if certain conditions are met or conditions breached. For example, EBITDA needs to hit, a particular, a particular target for there to be payouts or earnouts. So these are key considerations to make when evaluating different offers. Again, the timeline of the deal includes when closing can be achieved. One bidder may offer a high price, but takes significantly longer to release funds as compared to another bidder who's offering, I won't really call it a lower price, but a reasonable price, but will close the deal faster. So you also need to consider timelines, especially when it comes to the continuity of the business. Secondly is the investor. And here you'd normally consider the strategic fit of the investor with the company and the reputation and value add they bring to the table. And this is where we start talking, not only do you want a financial investor who will just bring the money and start asking for dividends maybe after a year or so, but also a strategic investor who brings value add to the table in terms of maybe the knowledge of the company, knowledge of new markets. So these are the things you consider. And sometimes it's always advisable to seek input from legal and financial advisors in evaluating offers, as some technical terms you may not fully understand their implications. So always consult your lawyers, your financial advisors to ensure that these terms are fully understood. Again, when it comes to offer letters or what we call indicative offers, some offer letters, these ones provide, it's a document that gives you a full overview of the essential components of a potential investment. And details include technical details, funding timelines, and release methods of the funds. Again, indicative offers are what we call also non-binding offers. And these are like the first expressions of serious interest from potential buyers. Some of these offers are normally made after a first round of due diligence and therefore give an indication of the offer value in terms of the amount of investment and initial structure proposed. Other offers are made before due diligence. After the company sees the marketing documents, it says, this is the offer we are giving, subject to a due diligence. We've seen offers being revised after due diligences because some issues or some challenges were unearthed at the due diligence stage. Again, it is worth noting that indicative offers are non-binding, which means that no obligation to make the investment nor commitment on the price provided. But it's just to show interest, to express interest in that particular target company. Again, indicative offers will give the target company, valuable information in the level of interest and valuation expectations of investors. In an ideal scenario, this can be compared across multiple investors' options to always come up with a short list of the potential investors. Again, since offer letters can be quite technical to interpret and compare, this is where now corporate finance and transaction advisor often come in to add a lot of value in these processes if hired as advisors. So, and as you know, BDO is one of the corporate finance in our deal advisory. These are some of the mandates that we have, whether from a buy-side mandate or sell-side mandates. Again, there's also what we call term sheets. Again, these are agreements between the investor and the company that outline the essential legal and financial components of a given deal. They often have a time limit for completing a transaction or renegotiating it. And they also involve technical areas and structures that may require advice from either legal advisors, financial corporate finance advisors, or other advisors. Again, while term sheets, now, if you look at the level of seriousness, we've come from an indicative offer or an unbinding offer, normally referred to as NBOs, to a term sheet. Now, a term sheet establishes really serious intent. They are generally not legally binding, although some may include certain provisions such as confidentiality or exclusivity that are themselves binding. But generally, they're still not legally binding. Despite finalization of a term sheet, a substantial amount of negotiation and agreement still remains between the parties to finalize the deal. Now, I think we are getting closer to closing the deal. So we've moved from an indicative offer to a term sheet. Now we have the final offer. And the final offer normally takes place after due diligence has been done and some negotiations have gone on, and then they make the final offer. But also one thing to note is even after the final offer, some negotiation can still happen. But at this point, the room for negotiation or the door for negotiation is almost closing, but there's an element you can still go on and negotiate. Again, final offers now are the ultimate proposals made by an investor, which are presenting the best and final position they are willing to offer. Again, the final offer facilitates, finalization of a deal post-negotiation by bringing together the final and closest position of an investor. Again, it clearly details the terms and conditions of the offer. Again, to reach a final offer, this definitely there's been a back and forth exchange between the investor and the company until a mutual acceptable agreement is reached and a final offer letter can be submitted. Then once parties have accepted final offers and agreed to the terms, the final offer now becomes a legally binding agreement and the deal can then progress to closing. Again, it is important to understand the terms and conditions of the offer, and always consultation with the legal team is very key to ensure that whatever you've signed on, remember, once you sign, it now becomes legally binding, and you need to fully understand what you've signed. When you've signed on that dotted line, you need to be well and fully aware of what is expected from the potential target company. Again, just in closing, when it comes to execution and closing, once you receive the final offer, it's not the final step. There is still a step when it comes to execution and closing. And again, here it's where there is, final legal steps, including drawing of contracts, shareholding changes, regulatory approvals, new legal and corporate structures. Sometimes the organization structure slightly changes. So this could be needed, which will take additional time to complete. And then in addition, this period is also an opportunity to agree or outline the long-term working relationship and expectations with the investor, including meeting and aligning with new board members. Other documents to consider will be shareholder agreements. Again, this is legally binding to ensure that all shareholders agree in terms of operational guidelines for the company, and especially they specify the rights and responsibility of each shareholder. We also have what we call a sale and purchase agreement. Again, this is legally binding, just ensuring that the terms and process of a deal between the potential, now not potential, between the investor and the target company. We may also have things like 100-day plans. Once the capital is raised, what is the plan? Which work stream will be prioritized? How will management use the new investment within the existing structures? And also setting the right KPIs to track success. So in a nutshell, that is the offers and negotiation stage. I think you allow me to close there and take in questions and clarifications. Thank you.
Thank you all for joining us here today. We had one question that we're able to take, and if any of you have any more questions, feel free to put it in the Q&A tab as we have some time to discuss. So the first question is, can you please talk about what series of funding falls under each investor type?
Yeah, thanks for this question, Nick. I think this was covered in the first part, where these are more of VC type of VC type of funding, where they start with the pre-seed, then we go to the seed. Pre-seed is more on proof of concept. Seed is more they have already the concept is already up and running, and therefore they seed financing for more R&D. Then after that we kick in Series A, Series B, Series C, all the way to maybe Series D, E, and F, and it goes with the various life cycle of the business. So this is more of VC type of funding, and in a nutshell, that's how they look at it from a VC point of view.
Thank you, Eliud, for your question. So, thank you for answering that question, Eliud. And if there are no more questions, I'd just like to thank you all for joining us here today. And please do reach out to BDO East Africa if you on any services relating to corporate finance. As Eliud mentioned, the department offers multiple different services. And yes, if there is nothing else, no other questions. Okay, wait, there's one more question from Joe. Thanks for your question. The question is, comment on cultural differences and how they impact investment negotiations and what strategies can be employed to navigate cultural differences effectively. Thanks for your question.
Yeah, so one of the things that we discussed, maybe you'd go back to the slide on, I think the first slide on aligning expectations. No, just go down. Next. Yeah, so one of the things that we discussed was in terms of just ensuring that expectations are aligned, and therefore for cultural differences, remember the first step was preparation, just researching the investor to understand, how they look at things, how they approach things. And we've seen several investors come in, but because they come from different cultures, you find that they really have a hard time in Kenya. And I'm speaking from experience. And one of the things that you can mitigate this particular risk is always preparing yourself, and even before the investor comes down to have a chat with you or to negotiate with your company or an offer, before you put the pen to paper, you need to research on the investor and cultural differences, especially the source of funds. You'll find maybe funds, for just an example, you'll find that funds from the Middle East have a particular liking for particular sectors. You'll find that funds from DFIs and maybe other PE firms, they don't invest again in particular subsectors because of one reason or the other. And therefore, understanding the kind of investor that's coming in and the source of his funds is key to ensuring that you align the expectations and build a good rapport. The fifth point which was on trying to find commonality and connection. This is very key because these are some of the soft skills that are required when it comes to even dealing with investors. Therefore, cultural differences, if you've thoroughly prepared and you understand the source of these particular funds, including what the investor invests in. Sometimes you'll find a good indicator will be where the investor or previous fundings or previous companies invested by the investor. Therefore, this will give you a good picture of where the investor is coming from and his likely sources of or his likely sectors that he will invest in. Some funds, some fund managers, some investors, they say they are sector agnostic. But when you really look into their portfolio, you find that they tend to lean on one or two different sectors. And therefore, this would be a good indication of whether you align from a cultural point of view and also from a sectoral point of view. Thank you.
Thank you for your question, Nick, and thank you, Eliud, for your detailed answer. We have a few more questions. So for those of you asking about the webinar slides, we'll be uploading the recording on YouTube, so you'll be able to access the slides through there as well. And then there's one last question someone has asked. Thanks, Robert, for your question. He's asked, can you share a general case where you encountered complex technical hurdles during M&A due diligence that influenced negotiations or the final offer? How did you address these challenges to ensure a successful outcome?
So maybe not mentioning the client, but One that comes to mind during the negotiation stage, one of the shareholders was not felt that the company was being undervalued and therefore was not ready to sign on the dotted line. However, it took several meetings with this particular shareholder. His fellow shareholders convinced him, and us as BDO, who are serving as the strategic or rather the financial advisors, we also had to come in and talk to him and show the value add that these people were bringing on the table, and also not that his piece of cake in the company was getting smaller, but actually the ingredients of baking a bigger cake, and therefore his reduced piece would actually tend to be more when it comes in terms of value. And these are some of the challenges that come up where you find maybe 4 out of the 5 shareholders have agreed, but there's a fifth one who is always maybe needs more convincing. So that's how we went around this. Definitely, in terms of timelines, it affected timelines, but we also managed to convince the potential investor to add 60 more days, of which this was addressed. And therefore, there are many challenges that come in, but that's one example that, based on my experience, that I can remember. Thank you.
Thank you. We have one last question. Thanks, Robert, for your question again. Are there measures to implement during the M&A process to detect potential instances of money laundering or financial fraud?
Again, if I understood your question, from my experience, what I've seen, from due diligence side of view, there's also what we call vendor due diligence or investor due diligence, where the target company actually undertakes a due diligence on the investor. And when you do your checks, some of these things may come up where you find maybe the source of funds for this particular investor is not very clear, and there are steps to take on that. Either you don't want to, or you stop the negotiations, or you approach the investor head on to tell you his source of funds from a particular fund. So you'll find some investors funds come from different sources, and maybe one source is the one that is questionable, but where he will make the investment from is from another source. So these are all challenges that we've seen. Also, from a financial fraud part of things, we've seen fraud come up when financial due diligence is done on the target company, and therefore you find this affects the valuation significantly. And also, the controls have to be put in place to ensure that there's a smooth transition, because you also find in some instances, we've seen in the transition between where the strategic investor or the investor is coming in, that transition period always opens up, to, the target company is vulnerable to fraud, but there are some controls that are put in place to just ensure that this is mitigated as much as possible.
I think that's all the questions we had for today. Thank you so much for your participation and for attending this webinar. We have a few more webinars planned and hopefully a new corporate finance series. I'm sure a lot of you have learned a lot throughout this entire series. And if any of you have missed any of the webinars, as I mentioned, they're available on our YouTube page. And thanks to our expert panelist, Eliud Jorge, for providing expert insights on corporate finance and this webinar. Thank you so much and hope to see you at our next webinar.
Mm-hmm.